Hey guys, in this video we're going to talk about value investing, which is the key philosophy that underpins Tradewinds. Now, value investing is not a new concept. It's been around for about 100 years, and it is a tried and tested way of growing your wealth in the long term. The idea was created by a guy called Benjamin Graham. Here's a photo of him. And he's often seen as the father of value investing. And he has written two of the most famous books on this subject. The first in 1934, which he wrote with David Dodd, called Security Analysis. And the second book, slightly later in 1949, called The Intelligent Investor. And these books are both very famous within investment circles, principally because they actually make a distinction between investment and speculation. So Tradewinds, we are operating within that investment concept, putting money away regularly, maybe 10% of your salary every month into a long-term investment, maybe like a pension, versus speculation, which is trading. You're in and out very quickly, maybe in a couple of days or weeks or months, etc. So these are tried and tested ideas, and they've been popularized more recently over the last couple of decades by Warren Buffett. Buffett was actually a student of Benjamin Graham, and he even maintains to this day that Ben Graham's second book, The Intelligent Investor, is still the best book about investing ever written. So what the heck is value investing? Well, as we can see on the screen here, value investing is a long-term investment strategy that involves picking stocks that are trading for less than their intrinsic value. Or, I suppose to put it more simply, it's about buying stocks when they become undervalued or when they're cheap relative to their true worth. And this idea of buying things when they're at a discount is actually something that we're all very familiar with. Obviously, when we go shopping, if you ever see people, waiting for a sale to come along, they're going to wait. They know what the value is. So you can see here, the value of something is generally going up over time, if it's a good business or it's a good product. And in the stock market, the actual price of that share can go up and down, right? So there are times, as we've seen in other videos, where emotions run high, people get greedy, stocks are going up very quickly, stocks can become overpriced relative to their value, but then you've got a panic, right? You might have the global financial crisis or COVID or whatever it is. You're then going to have an opportunity to buy that stock when the price is below its true value. And as I say, we do this all the time as consumers. If you've ever seen people getting excited about a Black Friday sale, they are patiently waiting, possibly all year, and then the doors open, they get the opportunity to rush into a store and try and bag a bargain, right? And this is an example of panic buying. People are really keen to buy because they can see that the stock is underpriced. And we often think of the stock market where people are panic selling. Oh, the stock market, there's been a crash, stock market is risky, they're going to panic sell. In this example, they're panic buying, right? Once they've found what they want to buy, say if it's a TV might normally be worth $3,000, but hey, guess what? Today it's on sale. You can now buy that $3,000 TV for $2,000. And so people obviously vote with their feet and they get in when the product is cheap. And this idea is exactly the same as what value investing is all about in the stock market. If you find the right business, and we'll talk about how to identify the right businesses to do this with, you would expect the value of that business to increase over time, and you are exploiting the mismatch in pricing, right? Where the market can overreact and make things very expensive, or actually correct and retrace to a point where those same stocks, same businesses, in the short term become cheap, underpriced, you can buy them at a discount. So this is something that Warren Buffett has been doing for decades, and he is a key proponent of value investing because he's ensuring he's getting in when the investment is at a good value, when it's cheap and when it goes on sale. But he's also exploiting something called compound interest, whereby the longer you are invested in a market, the more your investments are going to grow. So if you had $100, it made 10% in the first year, you've now got $110. In the second year, you're going to get growth on the $110, and it grows and grows and scales. And Warren Buffett actually bought his first stock when he was 11 years old. And he's obviously been adding to that portfolio ever since. And he's attracted other investors into that journey, and the value of his portfolio has grown. And it's only really been in the last couple of decades that you're seeing this massive, almost exponential growth as compound interest has had that time to really work for him. So Tradewinds, we're about value investing, but we're about long-term value plays where the powers of compound interest can really create value for you. And just a quick example on that, if you had two people, investor one, they start investing early when they're 25 years old, and all they do is put $5,000 a year away for 10 years in a row, and then they don't touch anything. They will actually have more money than someone that starts a bit later, maybe when they're 35, and they invest $5,000 for 30 years, right? So $5,000 over 30 years, you think would make you more money than someone who was doing $5,000 for just 10 years. But the key here is to get started early. Invest what you can as soon as you can, and in the long run, you will see a greater growth trajectory. So Warren Buffett's company is called Berkshire Hathaway, and every year, like most companies, they release an annual report. And at the very front of this report is how Berkshire Hathaway is performing relative to the S&P 500, which, as we've seen in other videos, is the market index for the US stock market. So you can see here that for the period 1965 up until the latest report that was released in 2021 last year, the S&P grew just over 10% a year on average, and Berkshire Hathaway grew through its approach to value investing double that at 20% a year. And if you actually look at the overall gain in how value investing has outperformed the market might have gone up over 30,000% across that long time period, but the value investment strategy of Berkshire Hathaway has more than outperformed the market at 3.6 million %. So that is a substantial overperformance. And again, it's not complicated. It's using the same principles of getting in only when the shares are underpriced. So let's get into some of the specifics of exactly how we undertake value investing and how Tradewinds can help you on that investment journey. So as we've said, we only want to be getting in when the stock price is trading below the intrinsic value of the company that we're interested in. And we call that a margin of safety. The next thing is to make sure you're only doing this with businesses that you really understand. And in value investing circles, we talk about your circle of competence. So make sure you're only investing in businesses that you genuinely understand or that you might have used, right, in your day-to-day life. Those businesses need to have an edge, right? They need to have a competitive advantage that means they're more likely to have sustained growth, and they're going to have healthy financials, right? So just like if you go to the doctor, they look at your vital signs, your blood pressure, your cholesterol. You can look at the vital signs of a business. You can look at their financials, their sales, their revenue, their profit, their cash flow, etc. And you can make sure that those vital signs are positive, right? And they're going to hopefully lead to some long-term growth. If you want to make money in the long term, you've got to invest in businesses that are making money and growing. If the business isn't growing, you're not going to grow your investment. It's as simple as that. And one of the other things you can do is obviously just look at the management team that is driving those businesses. Are they delivering on everything they say they're going to deliver on? So one of the first things here is around this margin of safety. And we've had the graph earlier, but just to really hammer this point home, you've got the intrinsic value of a business. You've got a time where the price goes below the value. So in green here, you want to be buying within that margin of safety. There may be fear in the market, some short-term event that's driven the prices down temporarily. And you certainly don't want to be investing up here, right? So feeling you might even want to be selling, right? If your investment becomes really overvalued, if there's greed in the market's, tearing away, then, this is not the time to be getting in. You don't buy things when they're expensive, you buy them when they're cheap. And Warren Buffett, value investors, they talk about Mr. Market. So Mr. Market is just this way of explaining how the market tends to go up and down, subject to whatever's happening in the world, right? And as we've seen in the other video, things happen all the time. You need to be getting in when things are cheap. So this kind of emotion occurs in the market all the time, right? We're often fed pictures of people, on Wall Street or wherever, trading. There could be panic. People have had a bad day. The markets have tumbled. It's emotion, it's fear. The news is coming at you with all these kinds of things. And it's this exact fear in the market that as investors, we're looking to exploit. Now, the next big thing is understanding, well, what kind of business do I want to do this with, right? I want to invest in businesses that I understand, right? That I can really get under the skin of. And, one of the best ways to do this is to look at businesses that you actually have some insight to. There might be businesses that interest you. They might be products and services that you use, day to day already, right? You might be a regular customer of that business. It might be a brand, right, that you know and you trust. So one of the things that's probably worthwhile doing is just looking at your typical day. So, for me in the morning, what's the first thing I do in my day? Well, my alarm goes off on my phone, right? That wakes me up. I get up, probably brush my teeth, have a shower. I might use products from Unilever, things like Lynx deodorant, Dove shower gel. If you look at the back of that bottle, it'll have Unilever on it. They make all kinds of consumer staple products. I then go to work. I might work in an office. I'll crunch some emails. I'll write a report, do a PowerPoint presentation. Might get bored of that and check my social media. I might even decide to message my friend, right, for coffee later in the day. So on WhatsApp, I'll message him. Busy morning at the office. So then I'm thinking, right, lunchtime, time to get my credit card and buy some lunch. May not have a lot of time, so I'll just get a quick lunch in McDonald's, back to the office, finish off that report. So I might use Adobe, right, as a business to do that. After that, I might meet my friend for a coffee. So I'll go to somewhere like Starbucks, buy a coffee with them. Maybe I have a big kind of coffees, give me a lot of energy. So on the way home, I'm thinking, right, I might hit the gym. So go to the gym, Nike trainers, put them on, get home. And when I get home, I've had my packet from Amazon arrive. Brilliant. Really looking forward to that. Have some dinner, and then I'll probably search for that holiday that I want to get booked up for the summer. So I'll do that. Maybe watch a film with the kids before having a bath and going to bed. So this is obviously just like a hypothetical day, but it kind of shows you the different companies that you come into contact with most of the time without even realizing it or giving it a second thought. But these might be businesses, that you want to research or invest in. If you're a customer of those businesses, maybe other people are customers of that business as well, and they might represent an interesting investment opportunity. So the first thing is around understanding businesses, maybe that you come into contact with every day as an existing customer. The other thing that you might want to do is look at businesses that have a really strong brand advantage, right? So people talk about front of mind recall. So whenever you say like social media, what's the first brand that pops into your head? Okay, might be Facebook. You then think, okay, maybe if I want to search on the internet, I'm going to use a search engine. What's the first one that comes into your head? Okay, it's going to be Google, right? If I want to do some shopping online, what is a big online retailer? First one that might come to mind, say Amazon. Okay, so these businesses, they have a strong brand and they have very limited competition because they've got a monopoly pretty much in their sector. Okay, sure, TikTok, you might say, is a type of social media, or LinkedIn, but as a percentage of the social media market, is tiny compared to something like Facebook, right? Which is the strong brand, and that gives it that competitive advantage, and therefore is something that's worth investing in. Compare those businesses to, say, the airline industry, right? Where no single player has that brand monopoly. I mean, in the US, I just went on Wikipedia. I found a couple of airlines there in the US. There's a lot of competition, right? Within some of the big carriers, you've got little carriers that fly some of the regional routes within the US as well. And so airlines, given that massive competition, it means it's a lot easier for them to lose customers to other airlines because they're all vying for the same customer base. And for that reason, given the amount of competition in that sector, at Tradewinds, we don't typically invest in airlines because they tend to be very volatile. They can be a bit up and down. COVID, people can't move around, travel, too much competition, not something we would consider appropriate for a long-term investment. Okay, so we've talked about businesses that we understand. We've talked about having a strong brand. There's other things that can give businesses like a competitive edge. The first thing is locking in customers for the long term. We're value investors, we're in this for the long term. So we don't want to make it easy like the airlines for people to shop around and switch in and out. I've been using Microsoft for the last 20 years, right? All my documents happen to be in Microsoft Word. So it's going to be hard for a new business to kind of come in now because Microsoft has really locked in customers on annual subscriptions. Adobe, yes, it does PDFs, but it's got a raft of other software that is in Adobe. And so people, they do degrees, they study how to work within that Adobe ecosystem. So again, if you've spent money to be trained up in how to use Adobe, you're not going to then just want to switch out because you've trained for that software platform. When you look at people like Amazon and Walmart, these are like big businesses. They've got very large scale operations, and it's kind of hard for new market entrants to creep in and take on these big guys because they've got that scale of economy which they've already worked up, and they are then able to offer customers discounts. They're operating on thinner margins as a result. And I suppose just like the customer lock-in, you can look at companies like Facebook or Apple. Facebook has this huge network effect, not just through the Facebook platform, but people using Instagram and WhatsApp. Apple has this growing ecosystem originally around, like MacBooks and iPhones, and now you've got watches, you've got the App Store, you've got this really strong ecosystem which draws people in, and then it allows Apple then to cross-sell other products and services out of that ecosystem. So these kinds of things are what you want to be looking out for when you're trying to pick a stock. And these are the things that we feel at Tradewinds are important to ensure you can get a return in the long run, okay, which is what we're obviously all focused on. Now, in addition to all of that, the other thing you've got to look at are the financials of the business. Now, we're not like trained accountants. Maybe you are a trained accountant, you'll be familiar looking at company accounts already. But if you're not, don't worry. This is something that we can do fairly easily and also for free. So you're looking at the vital signs of a business. Is the business making money? If you want to make money, you've got to invest in businesses that are making money. Is their income growing every year? Is their revenue going up? If they got healthy cash flow from their operations? And I suppose most importantly, have they got a fairly conservative debt position, right? If you have a business that has really high debt but no profit, it's not going to be solvent for very long. So the way we do this, there's a couple of websites. You've got Yahoo Finance, you've also got Reuters. We're actually going to jump into Yahoo Finance just now, and just take a quick look at that. So you simply go to Google, you type in Yahoo Finance, and you call up this website. Free to do this. Let's have a look at Microsoft. Just type this into the search at the top of Yahoo Finance. Let's just try that again. There we go, Microsoft Corporation. Click on that. This gives you what the share is currently trading at. So at the time of making this video, $280 a share. And then you've got all this free information which you can access anytime. We're interested in the financials, so we're going to click on the financials, look at the income statement, and look at all the performance and how it varies year on year. So in 2018, we had 110 for Microsoft, 125, 143, 168, and trailing 12 months, 184, right? So the revenue of this business is increasing every year. Okay, that's great. Let's look at the cash flow. So click on cash flow. Let's look at the net income. 16, 39, 44, 61, 71, trailing 12 months. Okay, great. So the net income of this business is going up as well. Okay, let's see how that compares with a company, say, like General Motors. Let's look at General Motors. Let's look at their cash flow. So their cash flow, 8, 6.7, 6.4. Okay, it's picked up a bit last financial year in 2021. But this is not consistently going up, right? We want to be looking for businesses that have financials that show consistent growth year on year. If we look at the income statement, we look at the revenue, we can see it kind of leaking revenue there. It's kicked up a bit recently, but compared to something like Microsoft, which we just saw, this is not consistently growing sales. Okay, and one of the best ways to visualize this, if you're not comfortable with numbers, I mean, you've got to look at the numbers, but you can also go to TradingView. If you've not used TradingView before, please click on the link below. You can set up a free account on TradingView and you can actually visualize that growth in the business on a chart. So this is a screen grab of Costco, and you can see that over the last sort of decade, this business is generally going up, right? This is the share price, which you can see here on the right, and you can see how that price has changed over time. So Costco, yeah, generally a business in the long term is going up. Let's look at Google, right? Generally, you know, over the last 10 years, since 2012, Google has been going up, right? It's appreciating in value, and you want to be doing this over at least 5 or 10 years, okay? Now, there's a lot of other lines on this chart. You've got the green, the yellow, the maroon, and the red line here. These are called moving averages. I've got a separate video to explain moving averages, but it's basically showing you that the price is above all the moving averages, and all the moving averages are pointing up. So this is looking like a healthy stock because it's showing long-term growth. Now, if you look at something like Kodak, for a long time, since 2014, this stock was generally going down. You can see the price is below the moving averages. All the moving averages are pointing down. You had this ridiculous blip. I think this is when they started messaging around blockchain and maybe doing something to do with crypto. It caused this crazy spike. And ever since that hype, it started going down again, right? So, you know, this is not a healthy looking stock. It looks like a business, you know, which is losing value. General Motors, we looked at the numbers there. We saw a bit of up and down in the accounts. If you look at General Motors over the last years, okay, it's kind of gone down. It went back up again. It chopped around for a number of years. It crashed, as a lot of stocks did in COVID, and then it's bounced back, but then it's come down again. And, you know, as of now, it's trading round numbers around $40 a share, which if you go back 10 years to 2011, 2012, is about $40. So it hasn't really done anything, right? In 10 years is kind of where it was 10 years ago. And you can see visually how a stock like General Motors has had its share price differ to those other businesses where they're kind of going up more consistently. Now you can look at Zoom. You know, everyone's working from home now because of COVID. Maybe Zoom's a good thing to invest in. And yeah, sure, in the run up here from 2020, 2021, the value of Zoom went up. But then as You know, people have become vaccinated, returned to work, you know, the value's gone back down again. So again, you don't want to be investing in something that's going up and down. You just want to invest in something that's going up. And also, this only started trading within the last couple of years. So you're looking at 5 to 10 years, and you want to see it's doing this, right? Microsoft just going up. And when you start to visualize how different companies look from a price perspective, it becomes quite clear very quickly, you know, what is just the long-term consistent performer, right? It wants to look like this. When you've identified a stock like that, and you've gone through those criteria that we've discussed just before, you then want to start investing, right? So if we said Microsoft today, you know, is worth $340 a share, then obviously you want to start buying this when it's under $340. So buying now, we've been pulling back this year, now is a better time to buy, right, than if it was at $350 or $360. So you don't want to buy in one go. You kind of want to buy a little bit here. We tend to buy when the price hits one of these moving average levels of support. You can see historically price kind of comes down, it touches the purple line, that's the 20 EMA. If there's a bigger pullback, you know, it might interact with the green or the yellow line. And so the secret here is not to invest everything in one go, but to scale in, right? So if you had $1,000, maybe you do $250 there in TradeWinds. TradeWinds will let you do $250 buy here, maybe another buy here, and another buy here, right? So $250, you know, you've got $1,000 there, and you're going to average in. And it might be that it never gets down here, right? Fine. But if it does, it's always good to have a bit of money on the sidelines there, just in case there is a really big pullback. Anything below the intrinsic value is a bargain. You're buying it at a discount. The question is, do you want a 10%, maybe a 20 or 30% discount relative to that? I really recommend you check out the video on portfolio diversification. You don't want to be putting all your money, you know, into one buy point. You want to have different buy points, and you want to be doing this with different types of stock. So I'd recommend looking at that diversification video now. Just a final thought. It says here it's not necessary to do extraordinary things to get extraordinary results. So Warren Buffett here is saying that value investing as a concept is actually quite simple, right? You're buying a stock when it goes on sale, right? When you're able to get in at a discount. And that, you know, in essence isn't complicated, but if you keep doing that, you will get a good result. And the secret is to do it consistently in the long term. So he says, do not save what is left after spending, but spend only what is left after you've done your saving, right? Pay yourself first. If you're earning a salary every month, put 10% away, put it into the markets, and, you know, do that for the long term, and you won't go too far wrong. Thanks for your time.